Hello, welcome to today's Finimize community event. My name is Donna, and I'm the Finimize community host based in London, and I'm excited to be leading this conversation with you all today. With current inflation rate in double digits, with no sign of stopping in sight, the interest rate highest since 2008, and UK in a full-blown recession, it is harder than ever to gauge which might be a good asset type to invest in at the moment to safeguard and grow your hard-earned money. Property has long been viewed as one of the safer investments one can make. So today we will review what is the best type of property investment in the current economic climate and explore where are we in the current stage of property market cycle, as well as what are the best ways to invest in property. To speak on this subject, we are lucky to have a very special guest, David Clouter. David has been a landlord for more than 40 years now. During this time, he has successfully used many different strategies on his property investing journey, including HMOs and even hotels. Needless to say, he will have a lot of valuable insights to share with us today. For the live event, if you haven't already, please introduce yourselves in the chat with your name and where you're from. This is a 15-minute conversation followed by 15 minutes of audience Q&A. So don't forget to ask your questions in the Q&A box below and to vote on your favorite questions. Now that the introduction is out of the way, I will pass the mic to David, who will kick us off by bringing you up to the speed with your pathway to investing in property in 2022.
Thank you so much. What a great introduction, and it's a real honor to be here and a pleasure to have everyone on board. And so what I'd like to start by saying is that we were originally going to do this, weren't we, a fortnight ago, and then we rescheduled it. A fortnight ago's talk would have been totally different to today's, because since then we've seen a rather extraordinary mini budget, and we've seen the impact of trustonomics. We've seen the base rate go up on the Bank of England, and we've seen some kind of fluctuations. Now, I'm not a political guy at all, but I just came up with this last night, this indication of our last three prime ministers, and in fact, the last four. So you've got David Cameron and Theresa May, heads down, pushing the aircraft forward and just doing the job. You've got Boris with a bit of sort of choppiness there, but sort of going sort of arguably forward. But unfortunately, Liz Truss appears to have put the plane into a nosedive, heading for the ground at 200 miles an hour. So this is the thing that we're up against. Luckily, this will be my third property crash, and this is the time when the smart investors make money. So we're okay as far as that's concerned. We do need to let the dust settle a bit and to see what's happening. But within a few weeks, it should be kind of quite clear as to what's happening. So to recap for anybody who's been sort of bouncing.
Tell us, what is the best type of property investment in the current economic climate?
Right. Well, what we've seen is, and basically we've seen the Bank of England and the government doing opposite things. We've seen the Bank of England thinking, we've got to get inflation under control, so I'll raise interest rates. And we had this mini budget having sacked the head guy at the Treasury, which would be likely to be inflationary, and naturally the markets reacted. So what are we going to see as a result of that? We saw mortgages being pulled left, right, and centre. These mortgage products just disappeared, and they're coming back, but we're going to see interest rates go higher than I would have predicted. We're going to go, in my view, we're going to see base rate in 12 months sort of 5.5–6%. If you'd asked me a fortnight ago, I would have guessed 4.5. But with everything that's going on in the economy, this is the driving thing that is going to impact it most. And effectively, although property recessions have the same causes, have different causes, they all play out the same. So what happens is that, and they work in 18-year cycles, interestingly enough. So interest in property builds up very slowly. I used to tour the country talking about all this, and then it sort of overheats and goes almost vertical, and then people say, and it plunges. And the time to buy is at that plunge, and we're just at the top of the precipice, but it goes down very quickly. So we are going to see adjustments in prices. We're going to see in the residential, because people's mortgage, which might be £200 a month or something, is going to be £600. Their payments are going to triple. Even people like me on 5-year fixed at the end of those, and hopefully everybody who saw my advice earlier in April, for example, fixed their mortgage rates because they're a nice comfortable level. But the day of reckoning for everybody is coming. I've got a nice comfortable margin. So what will happen when that happens? Landlord, we're going to see for the first time since 2006-7, we're going to see repossessions of in domestic property. So that means that prices are going to fall. The top sort of experts, Winkworth and all these kind of people, are predicting that residential property prices will fall by about 15%. That gives an opportunity. The market may well freeze up. That's what happened to me in 2007-8. I just sold one just as everything started to tumble because I'd made the mistake of not watching America. I've been watching America and Australia very carefully now. So on that one, I just broke even, and then I stopped for a bit, and then I realised that suddenly there were some bargains up there. So then I plunged in, and so that's going to be the thing to do as far as property is concerned. And I came up with let me just start up my little laptop here, because this was a spontaneous thing. This was at the talk that you saw with me on in April, which is why I'm here today. And this is just a little graph of what would have happened to £100 invested in 1985 in different asset classes. And I don't want to sort of bore everybody, but basically the big line is property, and the little one are gilts, gold, the FTSE, the Dow, and all the other asset classes you could imagine. And you might think, well, that's a bit of a fluke. And then property in that time has made £3,558 from 100. That's a pretty good investment. Then if we look at a different period, we see the same pattern, slightly different numbers. That's from the year 2000 up to date, and £100 invested in property in 2000 in the right way would now be worth 968. That's a good return on your money. Interestingly, 95% of retail investors who invest in equities lose money, but they don't tell you that in the advertising. But property is solid, but you have to do your numbers correctly. So there will be opportunities in traditional buy-to-let. That's the first one.
Okay, so traditional buy-to-let, where are we looking for that?
Well, interestingly that you should mention that, because anybody who's in sort of London and the southeast will know that those numbers don't work anymore, and anybody who lives up north will know that your entire year's rental profit can be wiped out if you need a new washing machine or boiler. So the answer is to split it down the middle. There's a line that runs roughly from Bristol to the Wash, and buy very close to that line, because I'm a guy who believes in I don't just talk the talk, I walk the walk. I have rented out my home, which is in Cambridge, lovely place, and I can't wait to go back. And I'm living very close to that line right now, and looking for opportunities. And I've already bought some stuff, and the stuff I bought in January of this year, I've doubled my money using the strategies that I use. Although obviously the property hasn't doubled, but it's gone up by a sufficient percentage for my stake.
Okay. If we're talking, so to explain to people that are listening, a buy-to-let is not a property, not a residential property that you buy to live in. It is an investment property that you buy, so you can rent it out and profit from that cash flow.
That's correct.
So is that what we are looking at right now? Is that the best type of property investment in the current situation?
It's best for people just starting out, and even though I'm not just starting out myself, I still do it because it's an evergreen. It works through rain and shine, and as long as it's very important you run your numbers at the start, so you have to be a bit numerate, but other than that, it works rain or shine. It's worked for hundreds of years. So yes, I mean, the property, my first ever flat that I bought to let out was in 1985. Before that, I was doing another property strategy, but the first one I actually owned, and I paid £27,000 for it. Today, sadly, I don't have that one, although I do have one or two others. That one would be worth 450. My dad's house that he bought in 1960 for 2,000 is now worth 550,000. So there's a steady upwards progress. It sort of jumps up and down, but as long as you don't panic and sell in those little dips, you're going to go on making money.
Okay, so if you had to say, where are we in the current stage of the property market cycle? Are we just about to plummet? Is this actually a good time to buy? Should we wait another year? What should we do?
watch the market and look for drops. It can happen anytime. I don't think, well, there's certainly very unlikely to be any rises, and you have to judge it. But you'll always make money even if you don't buy at the bottom and it goes down a bit further. It's going to go up and go stratospheric. So there's a sense in which the best time to buy property is always today. But I'd say leave it a month or two. But I always keep on investing. There is one other property strategy we can do as well.
Okay, what is it?
Well, and that is one of the fashionable ones. I don't normally promote the fashionable strategies. This has become a doer. It's become a goer within about the last fortnight or so because of what's going on. And that is to buy commercial property and to convert it for residential use. In the trade, they call that commercial to resi.
Okay, can you elaborate a little bit more on that?
I can indeed. Now, the building that you saw where I gave my talk in April, just before when it was the credit crunch, that building was 1.2 million. Just after the credit crunch, it was 400,000. So you see massive revaluations of properties. A commercial property, and this could be a sort of shop unit, an office unit or something, it's only as good as its tenants, and its valuation is based on that. It's not like a residential property, which is just based on its area and location and this kind of thing. So we've seen it's a sort of perfect storm, really, because okay, we've seen the Brexit, we've seen COVID, we've seen Ukraine, and now we've seen trust. So these are kind of things influencing the market negatively. COVID made people work from home. So I know office blocks now which are built to house 30 people or something, which have got 4 in rotating on hot desks and everything. And these people are waiting to downsize when their tenancies come up. Walking in any high street, even in Cambridge, you see empty units. So because COVID drove people A, to Zoom, which is why we're doing this in this way today, but B, to Amazon and other online retailers. So in all sectors of commercial, the demand has plummeted. This will affect the values of these units, and by buying, this is not a beginner's strategy, I would emphasize. So for anybody who's coming at property for the first time, buy a few properties, domestic properties, let them out. But for people who are a bit more advanced, the planning rules, again, I think that was under Boris Johnson. They didn't want to have a desolate high street wasteland, with scrub going along the road. So they relaxed the planning rules to such an extent that you can kind of buy a property from, for example, banks who are closing all their branches. This kind of thing. They're not too concerned about what happens to the individual property and costing on the same. You can do your due diligence. You can bag some bargains. You can, within 56 days, under a thing called permitted development, get the planning permission. You can put the stuff in, and it can be up and running very, very quickly. So you're not stuck with expensive borrowing for a long time. And there'll be a queue all the way around the block to rent residential properties. There's a huge shortage because of mistakes that the government has made. There are far more. For my properties all across the country, there are about 20 tenants for every property who come on instantly, and I manage all my own myself.
David, so we mentioned buy to lets are great ones, commercial to resi are great ones. Is there anything else before
that's it for today. That's what I'm doing, and the others, because of the sort of uncertainty in the market, shall we say, until things settle a bit in a week or two's time, I wouldn't recommend any others at this point. But if we talk again, then at some future point, I may have a different view.
Fair enough. Thank you for that. So we've established what could be a good types of investment at the moment. What is the best way to actually go and then invest in these types of properties, say buy to let, which is a little bit, let's say, more accessible for everyone? How does one go about it?
It's to do your homework, really, and to look at an area, to look at these things like Rightmove. You can actually see how quickly properties are renting. You can see how quickly properties are selling. So you can get a view from that. And then we need to, if you like, divide the cost of the thing by the income coming in to make sure that you're covering the mortgage and this kind of thing. And there comes a point, there are a lot of areas, London and Cambridge and all these things are very difficult, Oxford and so forth, because the return is quite low. But you need to make sure basically that you're covering your costs comfortably. and then you go and visit a mortgage broker, get a mortgage, look at how long you want to fix it for. At the moment, you know, they're quoting quite high rates, so you might not want to fix that for 5 years because I think the storm will pass. It always does. And then you find good tenants. That perhaps comes a bit with experience. Letting agencies just take the first person through the door and stick them in your property. So I'm not a great fan of that. I'm sorry if there are any letting agents watching, but I like to vet people carefully, and I will take, you know, I'll whittle it down to about 3. I have some questions that I send out to people, and that normally gets rid of half of them. And then I look at the remaining ones. I'll go out for a coffee with the first 3, and just see who I get the best vibe with, really. And so far, you know, if you're a good people person, you can do that.
Okay, thank you. You touched upon interest rates a little bit. So obviously with buy to let, the idea is to get an interest only mortgage, correct?
Correct. Yes. Yes.
Right. And at the moment we have a 2-year fixed, or we have 5-year fixed, and you're saying this was going to be one of the questions actually.
Yes.
Saying it's better not to fix the 5 years because of the high rates.
Yes, I mean, I fixed all mine at the beginning of the year at 5 year, and because I saw, if you'd asked me at the beginning of the year, I'd have said that rates would have peaked at about 2 to 2.5, and that's what all the experts were saying. But now rates are going to go at least as high as 6. But it could be worse, because when I started in 1990, I was 2 or 3 years into my property journey, still in my diapers. But rates went up to 15 or 16%, the base rate, and those were very scary times. This is just, you know, a little interruption. But for people who've known low interest rates for a decade, it might be a bit of a shock to the system.
Mm-hmm. Thank you, David. So to summarize today's talk, we have learned about what stage of property market cycle we find ourselves in, what is the best property type to invest in at the moment, and how to best do it. I would like to open the Q&A for the audience now. I see we have quite a few questions already. So let's see. I am from Addie. I am new to property investment and thinking of buying a buy-to-let property. Can David be my mentor?
I mean, look, at the end, you're going to give my Facebook address, and I will reply to everybody with helpful advice, because at the moment, I've got a lot of time on my hands, so I'm not doing any properties for the next week or 2.
Perfect. I will leave the link in the description below. So next question. Do the ever increasing regulations for landlords concern you as to the longevity feasibility of the buy-to-let market?
Absolutely not. It squeezes out the capital, the casual people, and then with an oversupply of properties, the prices fall. So I buy some more. I mean, I admit it's not as easy as it was, and there's a lot of paperwork now, but it's just box ticking. You do this, you do this, you do this, you do this. It's a pain when I'd rather be, you know, I don't know, mowing the lawn in the property I'm about to let or something. You know, not that I would, but you know, it's do it and you won't have any problems.
Okay, thank you. Now, I'm a prospective first-time buyer and pay £2,250 in rent in central London. At current mortgage rates, disregarding that they are continuing to rise, the monthly interest rates on a 425,000 property are more than what I pay in rent. Does it make more sense to not purchase the property, disregarding other factors for the purposes of this question, as buying would simply be speculating on the real estate market in terms of capital gains whilst being exposed to volatile interest rates?
Well, how does this grab you? Why don't you continue to rent in London? And I am renting at the moment in the place where I live, and ironically, I've rented my own home out. So why not do that and look at buying a property that you can rent out, so you can become a landlord and a tenant, which I currently am. I've been that for 18 months now. I've let out the family home. It's no problem. How about that?
Okay. So let's see some more questions. Okay, so everyone is talking about prices fall since the pandemic. Why do you think it will happen now?
It'll happen now because what's happened over the last couple of weeks is a game changer. The rise in the interest rates mean that basically the late entrants to the market, the people who bought buy-to-let recently and who possibly took the maximum amount of money that the banks would lend them, which I never do, they are in trouble, because when suddenly they've done their sums, they've looked at their monthly outgoings, their monthly outgoing might have been £300. Well, when their current product ends, their monthly outgoing might be £900. They're not going to be able to triple the rent. So that's the thing. So recent entrants, and these are always, I saw people in 2007, they had long bunches of keys hanging by their belt, practically touching the floor, and they were boasting and all this kind of stuff. And I thought, you guys won't be around long, and sure enough, all those guys disappeared. So property is a long-term investment. Do it slow and steady. Maybe buy one a year or something like that. Don't buy 50 all at once. That's a terrible mistake. And sort of ease yourself into it. It is the best long-term asset out there, as we saw when I held up my little graphs. You can't go wrong, but you have to keep a firm hand on the tiller, stay confident, and don't be spooked every time the Daily Mail or others say sell. Don't.
Okay, and definitely do your due diligence initially.
Absolutely. Very important.
So if you could only hold a property for, say, 3 years, is it worth it financially to buy now and sell in 2025? Or would the capital gains wipe out any gain and thus make it pointless to take the risk?
I wouldn't buy a property ever really to hold it for 3 years, because property is a long-term investment. You've got costs of entry, you've got stamp duty and this kind of thing, you've got legal fees, you've got a setup charge for a mortgage and all this kind of thing. That wipes out short-term gains.
Sorry, the person actually meant to live in it as a principal place of residence for the next 3 years.
Oh, okay. Now that's an interesting one, because, well, again, you've got the costs of acquisition. Do the sums. Look at the 3-year period in question. So it's more or less the same as my previous answer was. Look at how much you would pay in stamp duty, mortgage, and compare that with what you would pay in rent. And in 3 years' time, assuming that you're then moving to another job, because that's kind of why people relocate. If you had bought the house, you could always go to the bank and ask for permission to let. You could keep that house. You could rent it out, and you would have some income coming in and a continuing to increase assets. So that's maybe a solution there. And then you would go to the other area and again, initially rent first and then buy something there. And you could end up with houses all around the country that way. I know people who've done that.
Mm-hmm. Thank you, David. What's the alternative to buy to let, and what would be the best way to start investing if you don't have access to a huge amount of money?
There are things that you can do as an alternative to buy to let or to commercial to resi. They mostly involve kind of obviously boots on the ground, and I think the best thing to do would be, for example, to get a secondment or something to an estate agency or something and learn the ropes. I don't advise people to sort of go out there on their own and become property sources or anything like this, because it's complicated until you know it. You can't learn that in a day or two. So how about changing a change of career to work in property? And I know a lot of people who've gone from property related careers, brokers, estate agents and so forth, and they think, hey, I should be doing this myself. So that's a good idea. So my strong advice to people is don't give up the day job, because then you're no longer eligible to the cheapest mortgages, and that's particularly relevant now.
Yes, definitely. So another question, in the UK, do you think there is a big difference in the appreciation of freehold versus leasehold?
Now that's an interesting thing. Possibly not if you look at the capital appreciation, but in terms of the net on the rents, there's a massive difference, because you will have to pay all the sort of freeholder charges. You'll have to pay exorbitant charges for somebody to come and clean the communal stairways or to trim the garden or this kind of thing, and that wipes out sort of half of your profit. So that's and also remember that a lease is a diminishing asset, whereas a freehold is always there for you.
Okay. Thank you. How to gain knowledge about property market and how to start? What kind of research do we have to do before starting?
That's a good question. Find yourself an expert or something. Find someone to hold your hand a bit when you started. I was very lucky. I got a guy who helped me out. It was just a chance meeting in this case. But now we've got the internet. There's a lot of people out there who are willing to help. But do your diligence and find somebody sort of helpful who might be prepared to hold your hand. It might be somebody you know. It might be somebody's brother or cousin or something who does a bit of property.
Thank you.
That's the best way.
Nikolai asks, what's the best way to access capital or begin for a beginner investor? And do you have advice for tools that can be used when researching locations?
Well, that's a good question. Zoopla is quite good for a beginner because they give you an estimate of how properties work.
What did you say?
Zoopla will give you an estimate of what properties are worth. They're not 100% accurate, but they're a good one for a beginner to start. You can certainly compare one area with another. Best way to access capital is to keep the day job, really, and go and see a good broker, and then they will advise you of the best markets, the best products on the market. And you know, before I worked for 15 years at the BBC on Radio 4. I had a lovely time there, but before I left the BBC, I fixed all my mortgages on the basis of the salary that I had, and then that lasted me for the next 5 years while I was growing the property business, at which point that income became enough to justify the next lot. So the biggest mistake that new people make is leaving the job too early, because also once you've left the job, you've got more expenses because you're going to for coffee every day with people, and this kind of, you're doing stuff when you'd normally be in the office. So stay working, find a good broker.
Thank you. Hassan is asking, what would you recommend to a first-time buyer? My wife and I wanted to try and buy a home this year, but the interest rates are concerning.
That's a very interesting one, because yeah, the interest rate rises are also going to factor through, obviously, to rents, and that's something to bear in mind. So, you know, maybe work a bit of overtime at the job or something like this, you know, get some more money coming in, and then by the time you've done that, prices will have fallen a bit, rents will have gone up and prices will have fallen. So it's the perfect storm, if you like, over the next 2-3 years to buy something. Look for an area. I mean, like, people don't buy in central London anymore. They buy an hour out of London and commute and this kind of thing. So assuming that's where you are, but you know, you might need to travel a bit every day, do a bit of a commute, but you know, look at the country very carefully. You can see all these prices. Again, you can go on Rightmove and see a whole area and circle a little town and see how much things are. And you know, nothing beats, however, boots on the ground. Spend a weekend where you're going to live and go to those streets, you know, at 9 o'clock on a Friday night, because that's very different from sort of 10 o'clock on a Thursday morning when the estate agent shows you around. So just get to know those areas. Also, go to a cafe for lunch and ask the waiter, what's it like around here? All that sort of stuff.
Do your due diligence, 100%. Lakshmi is asking, can you say how the property value is going to go down? Because the fundamentals seem strong, that the high prices are due to a shortage of houses.
Yes. It's not supply and demand, interestingly, and no other expert will tell you this, but it's not supply and demand that drives house prices, because people want one all the time. I'd like some more, and I'm sure you would. What drives it is a thing called mortgage credit impulse, which is effectively, in layman's terms, sorry for that bit of jargon, it's the bank's willingness to lend, because we buy apples and oranges at the market with cash from our pockets. We buy property based on the bank's willingness to lend. So that is the driver, and banks are very risk adverse. They will snatch away that umbrella they lent you on a sunny day at the first sign of rain. And that is coming back to commercial properties. That's a danger with commercial properties. So there wasn't time to slip that one in. But once you've got a buy-to-let mortgage, that's it. You're locked in and everything's good. Banks can get a bit iffy with commercial, so you do need to bear that in mind. But yes, so the best thing is, you know, just again, it all comes back to due diligence and management of risk.
Mm-hmm. Okay, thank you. David is asking, a recent article said property will fall 33%. If you have a property, would you sell now to get the cash and buy back later after the drop?
A friend of mine did that with hotels, actually, at the time of the credit crunch, and he sold his hotel for 1.2 million and bought it back for 400. But you know, he was a very wise and shrewd kind of person. I don't see properties falling by that amount. If at the new levels of interest, it's going to continue to work okay for you, I wouldn't necessarily do that, because you're risking, you know, it's a bird in the hand and the two in the bush. So you're risking it all for something that might not happen. Certainly, I see no way that properties are going to fall by that much, although, you know, I have been wrong in the past. I gave an assessment in December 2019 of how 2020 was going to be, and that was boshed as soon as COVID came in. So I've been completely wrong on that one. So nobody's got a crystal ball, but I don't see properties falling by that much. And what would you do with the money in the meantime?
Fair enough. We have quite a few more questions. I'm going to try and go through them. I want everyone to get their answers.
Yes.
So what are the 3 questions you ask prospective renters to weed out the wrong ones?
Oh, I've got about 5 or 6, but the most important one, and you know, it just establishes whether they're serious. The most important one, which is about number 6, is do you have a UK resident guarantor? And if they don't, I won't touch them.
Okay. Anything else that's really important?
Off the top of my head, I don't know because my PA does it, but that's the last one we put in recently.
Okay,
and you know, are you in full-time employment? How long have you been in what are you earning? Are you okay for me to do a full credit check and due diligence on you? Can I write to your landlord? Have you got a referee? That sort of thing. But that last one is the important. Everybody asks those, but not everybody asks that last one.
Thank you. Lakshmi is asking, can you talk about alternative ways of getting financing for your first property instead of the traditional bank loans?
Well, there are people who make a big deal out of JVs, which are joint ventures, and that's where you work together with somebody and they put in the money and then you do the work. In practice, what you find is that most of these JVs are with your rich uncle or your dad or this kind of thing. There are not many people who can go out there and find a stranger. It's great in theory, but it doesn't work so much in practice. So perhaps you have got some old relative or something, you know, who's got, and you know, there's people might have. The old relative might have some old property as well that he's let out. You might be able to improve that for him, and you might be able to take over the management and that kind of thing. So look at the first. Family and friends are the first port of call, but be credible. You do your homework. Have a sort of 2 or 3 page. I mean, that will be on a tablet, wouldn't it? But it's back in the day, you'd have a 2 or 3 pages of A4 with some proposals, some numbers, some photographs, and something to establish your credibility, and you know, take it from there. But you know, my dad helped me in the early days, and he was a very good fella for doing it.
Thank you. Sophie is asking, would you recommend a first-time buyer to hold off from buying a 2-bed in London, 1 to live in, 1 to let, until so 2 different properties, I understand, until the expected fall in house prices comes into play? It might seem like an obvious answer, but given extortionate rental prices in London, could income from renting a spare room and paying mortgages versus rent now offset the gain from buying a cheaper house in, say, 6 months' time? It is 1 property, sorry, 2-bed. Yeah.
So these are 2 separate properties. Without knowing the precise details of these,
it's 1 property with 2 bedrooms. So one live in and another room they would let.
Okay. Yeah. Well, I did that early on, and you obviously need the permission of your lender to do that. But yeah, it certainly helps with the bills, and provided this is somebody that you're going to get on with, it's not such a bad idea at all, really. And if you maybe a colleague at work or a good friend you've known a long time, and as somebody who is living in your house just as an occupier, they're not tenants, so they don't have the rights that tenants have. So you can ask them to leave any time. They're just licensees, and so you have the benefit of that as well if it's your home. But just make sure you don't breach the mortgage terms, and yeah, it will help with paying the bills.
Amazing. Sure. Another question, for a person new to property, is it better to buy as a company or in your name? What are the pros and cons?
The only reason that buying as a company became a fashionable thing is because some changes that George Osborne did in 2015 to the way that stuff is taxed. You only get tax relief at the basic 20% now, and this is particularly important on your rents. You're allowed to offset the mortgage, only 20% of it, not 40% if you're a higher rate taxpayer, which would increase your bills. This comes into play particularly as interest rates go up, because your mortgage is increasing, but so your tax bill doesn't decrease accordingly. So that's the reason we do it. If you've just got the 1 property, by the time you set up the accountant and the limited and all that, it's probably not worth it. But if you've got 6 or 10 or something, then it's almost certainly worth it. But you need very good, super sharp accountant who will tell you the best ways to do these things.
Yes, and it's all based on individual circumstances as well.
Absolutely.
So Rolo is asking, what data do you look to for an indication on where we are in the property cycle?
That's a good question. These days, I kind of look at my well. You can find graphs online and prices. You can actually Google property prices graph and go to Google Images and you'll see them. So that's as good a data as any, because I'm a very visual sort of person, really. If we're drilling down on a particular area as well, the Office of National Statistics has a lot of helpful graphs and stuff. Again, broken down by area. So sometimes even even the city of Peterborough has got its own graphs and that kind of thing. So that's sort of official government figures. But your Zooplas and your Right Moves and things have graphs as well. But go to trusted sources, not just something somebody's made up.
Okay, thank you. Vincent is asking, what is your take on fractional property investment based on blockchain?
Based on, sorry?
Based on blockchain.
Oh, on blockchain. Blockchain was very good. In fact, a friend of mine wanted to mine blockchain with me using a graphics card on a desktop computer back in 2012. I said, no, I haven't got time for that. Well, blockchain is going to be very useful for governments who are going to bring in their own kind of blockchain currencies and things like this. But
I think the question is more, what is your take on fractional property investment based on blockchain?
Oh, so in investing in a blockchain type fund that invests in property, are we saying?
Mm-hmm. That's I think.
I wouldn't touch it with a barge pole, because a blockchain now has got a lot of volatility, which property doesn't. So all my friends who were bragging about their blockchain type stuff a year ago have gone very quiet. And NFTs and all of those things.
Thank you. Nicola is asking, I live in Ireland and property prices are currently on the same level as the peak of the Celtic Tiger. Do you envisage a correction within the next 6 months, 1 year, as the current rates, inflation, and lack of supply make property less and less accessible to individual buyers?
Just remind me where that person lived?
Ireland.
Now, Ireland, are we in the north or the south of Ireland? We probably don't have that information, but Northern Ireland, I can tell you, was hit most of all by the credit crunch. It had the biggest impact on Northern Ireland. Northern Ireland, I don't know if it's even recovered to this day from the peak just before that. So Northern Ireland certainly has a few problems. I'm not familiar with the market in Southern Ireland, so I'm not entirely qualified to answer that.
Thank you. Addie is asking, will David recommend rent-to-rent business as a good strategy to make a start in property?
It's a good business if you can make the numbers work. And we should perhaps explain that rent to rent is where you find a property that's on the market that's up for rental. And then you approach the landlord or the agent and you say, I'd like to rent this, but I'd like to rent it out to other people. And you sort of divide it up. And the difference between what you got in rent, and you're doing this management and you're taking away all the pain for them, the difference between what you receive in rent and what you pay them is the thing that powers that business. And I would think that now is probably the worst time in the universe to do that, because all the property owners are about to jack up their rents because of the fact that their costs have increased through the absolutely astronomically rising base rate. And I've never known, as a percentage increase, I've never known the base rate to rise so quickly from, like, maybe what 1.8% or whatever it was in January this year to about 6.5 or 7% in January next year. As a percentage rise, that's massive. So these things could go pear-shaped, and in my view are probably likely to. So now, although it's a great strategy, now is probably the worst time on the planet to do it.
Thank you, David. Unfortunately, even though we have some more questions, we really do need to wrap up. So if you guys have any more questions, feel free to find David on Facebook and he will be happy to give you some answers.
Yep,
thank you so much for giving us your valuable insights. Thank you. And thank you to everyone who tuned in today. Remember to fill in on the feedback form that will pop up on your screens once this event is over, and let us know what you loved about the event. My name is Dana, and have a great rest of your day. Thank you.